Hi, this is Hutch with bankingtruths.com, and today we're going to talk about hedge funds and compare and contrast them to Index Universal Life, or at least certain features and benefits that Index Universal Life or IUL offers. So the reason why really rich investors gravitate towards hedge funds isn't always to outperform the market per se. It's often to get controlled growth or consistent yields. And so they pay a lot of money and hire these brainiacs on Wall Street to harness and control the volatility of the stock market, which can sometimes act like a drunken sailor, as you're seeing here in this chart, to produce those consistent returns for them. Now, this chart is showing the S&P 500 from midway through 2006 all the way to present day, midway through 2018. And you can see that there's been some really good times, but also some really bad times in there. Now, when you buy into a hedge fund, the fees are often, this is standard, 2% every year plus 20% of your profit. You could see in the S&P that could possibly have taken a while after 2008, assuming that they were somewhat tracking the S&P 500. There has been criticisms of late that since the S&P 500 has gone straight up since then, that a lot of hedge funds aren't even outperforming this. But going back to the fee conversation, when you unbundle the fees of a properly structured and max-funded index universal life policy over the course of a lifetime, you're going to find that oftentimes it's around 1.5% to 2.5%. So if we average it over the life of the policy, this is what it's going to be. What's ironic is Index Universal Life is often criticized because the fees start out really high and then go down substantially in the future, versus hedge funds or any sort of money management where the fee is really linear. It starts out low as you often have less money in there, but as it grows, you're going to pay more and more in fees. So you're going to pay this fee structure on your highest balance, whereas with Index Universal Life, you're going to pay the highest fees when there's the least amount of money in there. So the first premium, second premium, third premium, fourth premium, fifth premium, these are going to be your highest fees. And then a lot of times the fees fall off a cliff and the returns are the charges are somewhat comparable to index funds. Now, you could say, look, I don't invest in hedge funds, or I just have a financial planner. Oftentimes when you look at their fee, which is usually around call it the 1 to 1.5% range, and you add the fees of the mutual funds or the ETFs on top of it, we're getting close to what the fees of Index Universal Life would be. And I know some of you are saying, no, I just do index funds. I don't have an advisor. Okay, great. So here's what no index fund, no financial advisor, no hedge fund manager can offer you. What they're not going to do is they're not going to say, look, I'll contractually sign my name to a 0% floor. So if something like this happens, it's not happening for you. You have a contractual guarantee of no less than 0%. Now, that doesn't include the fees for the insurance, but even with money management, when you earn 0% in a hedge fund or anywhere else, the fees still come out. So that's a wash. Now, they're also, by doing so, they're going to limit your upside. And in today's environment, caps may be 11, 12, 13, somewhere around there. But if there was a hedge fund manager that said, hey, look, I'm going to sign my name contractually to the 0% floor and offer you this upside with no downside risk, I know a lot of people that would probably sign up for that. Now, the other thing about it is no hedge fund manager, no mutual fund, no index fund is going to say, look, I know you're trying to put money in here because you're saving for your retirement and you're going to keep putting it in here and we're going to grow it over time. But you know what? If you die prematurely, have this death benefit that comes in and basically self-completes all the payments that you never made. We're going to give you all the growth that you would have been entitled to, and we're just going to double or triple or quintuple or tentuple your account immediately if you die. There's no fund manager that's going to do that. They go out of business. The only people that can do that are insurance companies. And I know a lot of people, when they get Index Universal Life, they're not really doing it for the death benefit. It's just kind of an aside, which is fine. But because the death benefit exists, there are certain tax advantages that are really unique to life insurance in general. It doesn't have to be Index Universal Life, it could be whole life as well. So again, going back to our analogy, no index fund, no financial planner, no hedge fund manager is going to say, you know, my fund has this special deal with the government because we provide a social good for widows and orphans and failing businesses, that any of the growth you get, as long as you keep your fund, as long as you keep your money within my fund, any of the growth you get is not going to get taxed. And even if you take out distribution, as long as you keep money in my fund enough to support it throughout your lifetime, then none of these distributions will get taxed, and we'll still give your heirs a little something when you die. And upon that, then any potential tax that could have occurred will just be completely forgiven. There's just going to be no tax on any lifetime distributions, much less on the death benefit that we provide to your heirs. So as you're considering IUL as one of your financial building blocks, look at it through the lens that you look at every other purchase in your life. So you don't always buy the cheapest thing, or you always aren't looking for a free lunch. You don't mind paying as long as you're getting value for your money. And when you're considering the costs and the charges of IUL, instead of just taking the blanket opinions out there that it's too expensive, take a look at what you're getting for your money and see if you can actually get those benefits anywhere else. I'm going to quote my good friend Rao Garuda from one of my study groups. He says, "It's not too good to be true. It's too good to be free."